Appreciate the opportunity. My name is Erin Sikorski. I'm co-founder and managing director at MITAR Private Capital. My partner Mike Rosen and I founded MITAR in 2022 with the sole purpose of providing highly entrepreneurial, highly successful families and wealth management firms access to inefficient asset classes, initially direct private equity. So we're super excited about the very intentional, very immersive experience we're building for our clients. Prior to MITAR launching, I was chief executive officer of a firm in town, the Wellington Group, and prior to that, I spent 13 years in various roles at Carmel-based Oxford Financial Group.
Good evening. My name is Max Schilling. I'm the president of 2.0 Investor Relations. We're a subsidiary of Valeo Financial Advisors. Essentially, we're a value-add intermediary between strategic real estate sponsors and our clients at Valeo. So our team of 7 is responsible solely for the private direct real estate platform that we've built out. I may be the one masochist in this room because we do it internally. Right now, the portfolio, we're thematic in our pursuits, disciplined in the due diligence. Right now, the active equity portfolio is sitting around $900 million, normalized project cost of $2.5 billion. Very strategic with the groups that we work with, and we'll follow them wherever the market's telling us to go. Reno, Southeast, Midwest, Carolinas, and it's been a massive driver for Valeo.
Thanks. Hi, Erin Knauss. I'm president and CIO of Proteus Capital. We are a technology firm that provides all of the different pieces to make investing in non-traditional assets, really the institutional alternatives, easy for both the buyer and the seller. So we sit in between the investor and their advisors and the investment manager, and we provide simplification of everything from the subscription process that Jason was going through to the due diligence and sourcing of investment managers and all of the record keeping on an enterprise level, consolidating the K1s at the end of the process. So that's a little thumbnail. We do a lot of different things, but that's Proteus.
All right, so Jason did a great job of laying the groundwork for alts and some of the difficulties, but kind of starting off with it, if we kind of remove some of the operational difficulties, let's just start off with what do alts really provide for an investment portfolio? Let's start there and talk about that.
Okay, I guess I'll kick it off. So I'm going to go under the context, referring back to the last conversation, Jason was describing the different types of clients. We're going to assume, at least what I'm going to talk about, everybody's a qualified purchaser, so they can participate in these types of opportunities. So first of all, when I think about the private wealth management scene specifically, and clients that are looking to do this, when you're working with the upper tier of ultra high net worth, higher net worth clients, they most already are doing this. Whether or not they are working and investing with your firm or not, that's another story, right? So for RIAs especially, they need to be doing something differentiated outside of the 60-40 liquid portfolio. The client's appetite is there. They're already doing this, but to be able to provide something that's more professionalized, and again, referencing the last panel, to get access to these type of opportunities, that will be a big differentiator in your value proposition as a firm and the additional benefits that it has on the outcomes of the portfolio construction for the clients.
Yeah, I would just add, RIAs or other wealth management firms can very easily fall into a commodity service, right? You want to differentiate yourself. Between one or the other, if you're not providing something that's different, a value add, alts obviously provide that. You're targeting assets that are going to give, hopefully, outsized returns compared to the market. Now, we've planted our flag into real estate, but certainly private equity is very big. I don't want to dive into crypto. I'm not one of those. But it's to Erin's point, just you're trying to differentiate yourself. And it provides diversification durability and defense with the typical 60-40 portfolio structure.
And I would just add real quick, I mean, from the whole portfolio construction process, everybody can benefit from considering as wide an opportunity set, an investment opportunity set as possible. And so going outside traditional asset classes provides you with the opportunity to, I would say, build better portfolios. And so not all of the different opportunities in non-traditional investments are appropriate for every portfolio, but by considering them, you can build better risk-adjusted portfolios. And I think that that's the base case for considering alternatives.
Great segue, Eric. So let's talk about the portfolio construction process. There's a lot that goes into it. Let's kind of hold off on the cash flow piece, because that's probably a 30-minute conversation itself, and that's scratching the surface. But fiduciary responsibility to client and client suitability. We know there's a huge range. Your clients are all different, they have different goals. How do you determine the right suitability for their alternative investment portfolio?
So again, I'll keep this in the framework of qualified purchasers. So this is one of my favorite topics, and I'll try not to ramble on. But when thinking about allocating to actual client portfolios, private wealth is incredibly different than institutional wealth management in terms of the asset allocation and portfolio construction, in the sense that you have to consider several mitigating factors, such as liquidity. Are they in accumulation mode, decumulation mode? What's their tax sensitivity? Asset location becomes critical, especially in managing taxes and looking at different registrations, and how do you move that across? And I'll leave out the cash part. how do you manage that as funds are moving and you're building out this robust portfolio of different assets that are all moving in different directions, you know, and you have to watch the tax sensitivity within the portfolio itself, where you're getting your liquidity from to fund these various strategies. So there's lots of moving pieces, and it can become very complex very quickly, but it's also what makes it so much fun and so rewarding, and creates significant value for your clients, because you can integrate both the tax and estate planning alpha alongside the investment alpha and create something that's really dynamic and hopefully good for your client.
Yeah, just to add on to that, you know, I think it's going to depend on the client, right? And their appetite, their experience. You know, well, we have clients at Valeo that have a lot of real estate background and experience, and they want a lot of real estate investments. You know, I think middle of the fairway, 20% target for alts is a pretty good place to start. Liquidity, obviously, is very important for them to answer potential capital calls. And also the risk appetite. You know, we don't want our clients to look at this as, I'm placing one bet on one horse at the track. That's a nightmare scenario. So you have to educate your clients and say, we're gonna build out a portfolio of alts methodically on the risk spectrum, diversify it. But if you're looking to just cash in on one horse, this ain't for you.
Maybe I'll take a little bit broader perspective. And first, getting back to the why invest in alts. Everybody wants to be in the institutional alts. And the reason for that is that you're closer to the return driving engine. You're closer to the private equity or the private company. You're closer to the direct real estate. And the only way to really get that is through the institutional alts. But as we've noted before, very few can really participate in that, in building a diversified portfolio. So the industry has come up with lots of different ways in which to try to get close to those return driving engines. And so I would tend to think about it. We all have our asset allocation. We should all be working with an IPS. We all know our clients, and so the risk tolerance, the liquidity needs, the time horizon, all of that should be going into the decision-making process. And if it's appropriate, then you've got the opportunity. I would say I would break them down into three different categories. The institutional alts, a high net worth alts, which would be generally your interval funds, your business development corp, SPACs, tender offer funds, maybe hedge funds. and then your retail alts. And so these are individuals who are non-accredited and are looking for, maybe it's a gold ETF. Now that's an alternative, right? I mean, so you really have to think about how do you use these different things. And I would say in my history, what we've done is had 3 different sets of similar portfolios that are really designed for the different types of client profiles.
All right, let's get to the cash management part. So we made a bunch of commitments, got some money in hedge funds, we got a liquid portfolio. How do we make sure we don't default on those commitments? How do we make sure we get the right asset allocation?
So this is an interesting part because everything's moving at different times. So where you get your liquidity is critical, and how you're redeploying funds that are in decumulation mode as they pay out. So you have all these pieces, right? And you are obligated to make the calls and where they come from. So part of something that I think about when managing the portfolio construction piece is how to do that, right? You can pull from your liquid alts, but let's say you have direct private equity in there, and it's one holding, and it's just a home run, right? It knocks out the park. It's now 15 times what it was when it went in, but you only allocated 20% to your alts, according to Mac. That's where he's at. So now this is taking up 40%. Let's call it, the math's probably wrong, but 40%. So what are you going to do? Now you have a fund that's calling that you have to deploy capital to. So are you going to start pulling from your liquid equities to fund your private equity or your funds? Or are you going to pull it from bonds, right? Cash. You have to manage this because it's all moving and it's going to impact your asset allocation. So just quick thinking about it, where would you pull your liquidity from in that scenario? It's a trick question. So the answer is client expectations and communication. I mean, Mac was talking about it too. Your advisors need trained on exactly what this experience is going to be. The clients need to understand, and if those client expectations aren't met, and there's an issue, that's your number one problem. So you can have all the best thinking on portfolio construction or asset allocation that you want to, but at the end of the day, in private wealth management, if your clients aren't prepared for those, then that's your number one priority to be considering.
You're absolutely spot on. I think our platform has worked just with the relationship that we have with Valeo and how Valeo has structured sort of their advisory business with the clients. They intentionally limit advisors to 40 clients. They feel like you can't get white glove treatment to 200, 250 clients. When you're doing alternative investments, you're absolutely right. There's a lot of moving parts. If you don't have your finger on the pulse, you're gonna get in a pinch real fast. And so what's worked for us is our advisors are so in tune with what an appropriate allocation should be for a client that the equity ends up being very patient, right? And especially for our real estate sponsors, it can be very annoying when you have a $50,000 investor that should have put in 500 grand. It's a pain in the butt when a 500 grand investor should have put in 50. That becomes a very, very noisy investor. And what we've done, we work hand in hand with our advisors to make sure that the appropriate allocations are being met. We're carving off enough liquidity for potential capital calls or two if we have a staggered funding to make sure that that's met. And our clients understand, and you have to, again, it's communication, education with them. Our clients understand these are illiquid investments. And some of them view that as a bad term. I kind of like it, right? If you're disciplined in your approach, you have your themes, you're chasing those themes, and you do your homework before you invest in the project, illiquidity in that investment could be a good thing, right? Sometimes you're saving the investor from themselves. That's why you see the fluctuation in public markets. Obviously, people are panicking, pulling in and out. If you do the homework up front and make sure that you have this appropriate allocation unit size, you'll cut out a lot of noise.
And then just maybe operationally or implementation. You've got to make sure you look at these things, what your commitments are and what the pacing is. So there is a model that was initiated back in 2001 by two of Swenson's analysts. If you look it up, Alexander and Takahashi, they created what's known as the first pacing model. And what it does is it looks at anticipated cash flows in, cash flows out, and the return on each individual investment. And so if you did that and added that up for all of the closed-end funds, drawdown funds that you did, you would get a picture of what your cash flows were in and out. And so that really can form the basis for determining how much you need and where it might come from.
And that cash flow thing is, and the commitment thing is a huge issue for everyone, even institutional. We just, at IU Health, spent a week trying to explain why there's a footnote on our balance sheet that says we have $980 million of unfunded commitment. Even the CFO got a little bit scared seeing that number, trying to think about what that means for our cash flow. So this is everyone from retail up to institutional that's trying to figure that out. But moving on, so we now feel comfortable with our cash, got our portfolio constructed. How do we pick the managers? We heard a lot about key man and sourcing earlier, but there's a lot that goes into that. So let's talk through how we figure out who the best manager is, who's that top quartile manager that's gonna give us great returns.
So I don't do a lot of manager selection, it's direct private equity, but I will say when we're out talking with firms, something that we've heard thematically across several of these RIAs that are looking to enter the alt space is a misconception that they're going to pick up the phone and call KKR and all of a sudden get access to these funds automatically, and they don't pick up the phone for your $20 million investment for your retail clients. So that, I know that what they were talking about earlier today is critical for RIAs looking to access managers.
I guess our managers would be our real estate sponsors that we partner up with. And I say partner because we put such an emphasis on that. Real estate, really, equity, we get it. It's a commodity out there. Right now, it's more difficult to come by. However, we don't want to be viewed as a commodity. We want a partnership, relationship with our sponsors. We feel in the long run, we're gonna do better by our clients by having that strong relationship as opposed to a transactional relationship with these sponsors. And how we try to find them, it's a long dating process for us. When we onboard a new sponsor, we intentionally kind of drag that out for about 12 months to onboard a new sponsor. Most of that is to see, the ones that want a transactional relationship will let you know right away, hey man, are you gonna write a check or not? I need to close on this project in 3 weeks. That's fine, that's a fine business model, it's just not ours. And Jason hit on it, obviously past performance, past execution, while not an indication of future returns. Boy, you can learn a lot on how a sponsor has handled, tough times. Obviously, we want to know how they report. Are they transparent? Clients, it doesn't tick them off more than having a late K1, no transparency on the investment, and dollars going to the wrong account on distributions. So we look at that. We look at their decision-making power. How does that work? Their succession plan. Their insurance, their guarantee exposure across all of their projects that they're working on. We'll even do temperament checks. I firmly believe, and it sounds like I'm on a soapbox, but character is destiny. I really believe that. We'll do little things like take them out golfing, see if they break a club over their leg when things don't go their way. You can learn a lot from people that way. Take them out for a few bourbons, get them loose, see if they talk trash about their competitors or make a crude comment about a waitress. That matters to us because indirectly they're going to be a representation not only on myself but our advisors and our clients. And you cannot do good business with bad people. You just can't. And so you need that partnership mentality, that trust, because when things get a little choppy, I don't want to look behind me and see my sponsor cowering under a table. I want him to be, or her to be shoulder to shoulder with me, problem solving and navigating. These investments are not linear. They're not A to B, right? Behind the scenes, we're trying not to careen this car off the cliff or keeping it within a guardrails. You're problem solving right now with the rising interest rates and what that's done, especially on construction loans. So having a partner is a lot better than having a transactional relationship. And so you need to do the due diligence on the sponsors.
And that's fantastic. I mean, I think that's awesome. That's great. But I would just take a look again, sort of the way that we look at it. There's kind of two different structures or two different types of fund offerings. We've focused a lot on drawdown funds. And that's the more difficult of the two. There's a lot of institutional alternative strategies that are available through evergreen structures. And so I'll take that one first. The evergreen strategies are a lot more straightforward, or they fit into what we've done on the traditional side. You generally get monthly returns. You can fit into the MPT stats. There's databases with historical performance because it's one fund or one strategy. And so you can have all that information. You can set up peer groups, and you can do a lot of work to hone that down on the investment side. I can't talk enough about the operational side because these are exempt securities. They don't have to report like a registered product does. So you have to go and sit with the manager and talk to them about their cash controls, talk about their infrastructure, talk about their compliance. All of those different pieces go into the puzzle in deciding whether this is a firm that can maintain what it's done in the past. On the closed-end fund side, or the drawdown fund side, one of the key aspects of that is that they're open for a period of time, they'll raise capital, and then they're closed. And they won't be back in the market for another 18 months, maybe 24 months. So and for what we do is we're always looking to have an offering available. So whether it's a mid-cap buyout private equity strategy, one opens and closes. We need to know what the next one is going to be, which manager is going to be in the market, which ones do we like, and then after that, and after that. So we do a forward calendar. So you need to really know who's coming to market, who do you like, and the last piece is that you really don't have any comparative performance analysis. Yeah, you can get some, but it's all vintage year. So you can look at their past funds. You can look at vintage year 10 versus a couple of other peers, and vintage year 13 and 17. But you can't just say this is their performance, and that's a challenge. And so you really have to work with that in terms of determining how do you evaluate their ability to execute their strategy.
All right, next question. So we talked a little bit about some of the difficulties of trying to run an alts program yourself, but let's talk through the investment side. So let's assume we're in a bubble, there's none of the operational stuff that we talked about earlier. How do you build out a team and a program on just focusing on the alts, outsourcing it versus in-house? How do you make that decision on what's best for your firm?
That's a great question. Building a team in-house takes time. It takes finding people with the proper experiences and the breadth of that. Something that I've come to appreciate even more during my time in the industry is how unique it is to find people with an institutional-like background inside of private wealth management who have the quality of experience of that in institutions, but they can bring it in and understand how to work with actual clients and be client-facing and the nuances of working in private wealth management. And it's expensive. These are expensive people. So to get the high caliber talent to do all these things costs a lot of money on top of the technology and operational costs that you have to bring that all in-house. So finding a team or partners externally could be a very economical resource for firms looking to enter the alternative space in a way that could still make sense as they look at it from a business perspective in the margins on their business. It can be an extension, a line of business for the firm that can create significant value for your firm as well as value for your clients, which is what we're trying to achieve, that differentiation.
Could not agree more. We've built it out internally. My advice would be tread lightly. Erin's completely right. It takes time. You have to build out a team methodically. And then not to repeat what she said, because I agree with everything, you have to think about the risk as well, because there is something about kind of a political safe haven of outsourcing, right? You know, I'm a recovering attorney, did a lot of M&A work back in the day, and there was something about a client saying, well, heck, I went with the biggest firm I possibly could, and they may have screwed it up, but that's not on me. I sought the political cover, right? So that's the benefit of outsourcing. Now, you have to be mindful of the fees. When you do it in-house, understand and tread, why I say tread lightly, you're sticking your neck out. You're saying, we are sourcing this, we are running it, we are putting our stamp of approval on it, and if things don't go correctly, building out that kind of an alt platform can blow up in your face. It's taken us 10 years at Valeo to build out 2.0 to what it was. You know, historically, when we first did our first investment in 2008 with Browning, it was run by advisors for a little while, right? Volunteer firefighters is what I like to call them now. And as the portfolio started to grow and more opportunities started to come our way as people heard of what we were doing, the volunteer firefighters all of a sudden found themselves working in a very, very big city. And so the need for a dedicated team became apparent. And then it's a war for talent, right? You know, it's not lost on us. One of the things that I worry about constantly is retention of our team. You know, there's some people on our team that could easily make twice as much going somewhere else. So be mindful of that. It's not an easy lift. It's very heavy.
And I'm going to just talk about it from, I'm assuming that you're all running your own practice and you want to include alts. And so what would be the thought process? And we get this question, or really we talk to advisory firms and they say, you know what, we want alts. And like, we want alts, we want one solution, we want it to be available to all of our clients the same way, and we want to run it internally, we want to be able to make our own decisions and go direct. And when you think about all of those different conditions, they don't mesh. You really can't create that type of environment. So you have to think about a couple of things. One, what are the resources and the skills that you have internally? What resources do you have to spend? Because outsourcing is probably more economical than trying to build it in-house. And so you've got to think about what points might be best to outsource to be able to support what your skill set is internally and what you want to do. And then thirdly, I'd just say, what's your client base look like? If you're all, you know, really sort of retail or high net worth, I mean, there's a certain set of alternative investments that really is not that cumbersome. It's not as heavy a lift if you're going and really trying to go into the institutional world. So trying to understand and place that, if you really don't have a whole lot of qualified purchasers, there's no real reason for you to go and try and build that capability or be able to offer that capability, unless you want to go upscale, unless you want to be able to attract the larger and larger clients.
All right, last question, we'll wrap it up. It's a little bit more fun. Let's talk about our favorite asset class, or Mac, your favorite sub-asset class.
Thank you.
Now I want to hear about your private equity opinions. So yeah, Eric, you get kind of the wider gamut since you guys cover everything, and Erin, whatever you feel like in the direct space you think is interesting. But I'd love to hear your guys' thoughts on what you find interesting in the market.
Obviously, my answer is direct private equity.
Which
Find it fascinating.
sub-industry?
Yeah.
Do you have a sub-industry you like best?
Actually, I really like financial services. I don't know if Mike would agree or not, but I find it fascinating, maybe because of our backgrounds, I don't know. But financial services is very interesting.
I think in real estate, you're gonna see people going 3 different ways. You're gonna see folks going into niche asset classes, cold storage, student living. You'll see folks that are going to best of quality of assets that are currently experiencing unbelievable demand disruption, office. but they're gonna try to rebound with going to the best quality assets out there. Or they're gonna stick to strong secular demand growth stories, so industrial, multifamily, senior living. That's where we're really focusing on now. Industrial, you have to be cautious. Oversupply can happen, and I will tell you, sitting on an empty million, we're not experiencing this, but sitting on an empty 1 million square foot bomber on a construction loan in a rising interest rate environment is not a situation I want to be in. But you know, e-commerce, once consumers get a taste of next day delivery, same day delivery, you cannot unring that bell, right? And so it's all about getting close to roofs, and there's certain submarkets that we're really bullish on. Reno right now, Tahoe Reno Industrial Corridor, 0.1% vacancy. We're fortunate enough to have 3 sites in that submarket. Multifamily, that story is just getting, you know, the chronic undersupply of single family homes is getting worse and worse. You know, by 2035, we're gonna need nationally 4.3 million more multifamily units. You know, that comes out to about 330,000 units being developed a year. We're coming off of 2 years of historic development at 420,000 units in 22, and then 360,000 units in 21. And we're already seeing a slowdown, right, with the disruption with construction costs and interest rates. So that is being exacerbated, that problem. Senior living, I'm very bullish on this. For my smooth brain, that's a supply and some demand story that I can wrap my head around. You cannot stop people from aging. And I will tell you right now, our country is wholly unprepared for the baby boomer generation entering that space. We talk about a little over 3 million units are needed in 5 years, and the industry as a whole develops 36,000 units a year. That's a catastrophic supply and demand story. So that's kind of what we're focusing on. I think we're gonna batten down hatches in 23. I think now is not the time to pioneer. And to be honest, you kind of have to be a knucklehead in the last 5 years to not make hay in some of these real estate investments. So I don't wish ill will on anyone, but there's going to be a time where the cream rises to the top this year, because you see syndicators that have gone out and raised $20 million funds, and they were Starbucks barista 6 months before that, right? And they've called themselves operators, but let's be honest, they have not been operating, they've been flipping. And right now with the capital markets kind of log jammed, they're gonna be forced to operate for the first time. Closing a transaction on real estate is not difficult. Operating the assets, that's difficult. So it's gonna be interesting seeing that come back, see if there's acquisition opportunities. What's also interesting, the B-REIT, the Starwoods, they're almost doing quantitative easing right now, right? With these redemption requests that they're receiving. You know, someone that's not fully understanding of the industry would think, well, they're gonna offload some of their lower value assets. That's not what they're doing. They're strategically offloading their best assets to keep the comps externally, both externally and internally, for their mark-to-market triggers. It's very interesting to see what they're doing, and will that carry the day, get us through the choppy waters with the comps kind of not having much deviation. Cap rate expansion is happening, so Indianapolis, you know, if anyone tells you what they think the cap rates are, they are lying, because there hasn't been transaction history recently to give us sort of a solid answer. But my guess is Indianapolis is a 5.25, 5.75 industry. Honestly, that's probably where it should be, right? I look at what's going on in real estate, and I liken it to a normalization, right? We're getting back to where we probably should be. Values got way too high, all that money coming in. So my one concern though, and then I'll hand it off, I'm worried about when Jerome Powell feels like he has a grasp on the situation. And we have $300 billion of dry powder waiting on the sidelines, and what that does when that floods back in. So
Hopefully build senior.
that's right. That's right.
Well, Proteus, we offer across the asset class spectrum. So we offer investment opportunities in credit and private equity and real assets, real estate, infrastructure, natural resources, as well as hedge funds. So these two cover private equity and real estate fantastic. So I won't go there. So I'll get back to credit. And so the way that we see credit, or the credit market right now is, while spreads have come in a little bit since the beginning of the year, they're still at near GFC wide. And so there's a tremendous opportunity, we feel, in that if you look at GFC and Lehman's going out of business, Bank of America's got to buy Merrill Lynch, we don't have any of that type of or level of uncertainty in the market, and to have the spreads as wide as they are right now, in addition to that, and a lot of the pain has already been exerted in terms of the valuation. We've had some downgrades and on the loans. So one would say, well, the loans are floating rate. Well, those loans are to lower quality companies, and guess what? With higher rates, it's not the interest rate of the loan that they're paying, it's their ability to pay the loan itself. And so there's been downgrades in terms of the credit quality. So we think, and then the third piece I'd say is rates, or the interest rate that you can get currently off of some structured CLO product, some agency-backed mortgage, from senior secured direct lending is in the high teens. And you're buying these debt instruments at 70, 80 cents on the dollar. So the managers that we're talking to in the credit space say, we have never seen an opportunity like this. So we don't feel, and they don't feel, that there's a huge default cycle coming up. Maybe, we're still at kind of 2 and 3, and it's going to play out, and it'll be 4 or 5, but that's kind of normal for you to offset a 15 or 18% current yield on some of these, a double B CLO that has equity tranche below it, protecting it. You'd have to have 25% defaults just to not break even. So the opportunity, and to say that you can get 20% potentially for the next 3 years out of some of these strategies, you have to question whether you can get that in the equity markets themselves. So we think that there's some great opportunities in the credit market. So I won't talk about some of these. We think real estate has got some great opportunities. Valuations, there's a little bit of a lag in that, so we may see a little bit of revaluation there. But and then one more piece, the sort of relative value or arbitrage hedge fund. There's some opportunities in credit arb, and so what credit arb is doing, so you're the equity. So equity owners think the company is valued at this, and the debt owners think the company is valued at this. And so there's this tremendous spread between the two. And so who's right, it doesn't really matter. If you sell this one and buy this one, they're gonna equalize somewhere. So in the hedge fund sort of relative value, absolute return space, credit arbitrage is probably one of the most attractive right now.
All right, let's give our panel a hand. We'll have Jerry come back up. We have some scarves.
Oh, awesome. Thank you. Great.
And we're tonight because it's 60.
Actually, if we could, and I know Jason, I think David might have popped out, but Jason, you want to come up? We'd love to get a picture of you guys with your scarves. We got to do the guerrilla marketing here. But thank you for everybody for coming out. Thank you again. Can we get another round of applause for all of our speakers? So, like I said, hopefully you guys check us out. Follow us